We are discussing automobile ancillaries and Bharat Forge's earnings, like the others, has missed the mark. Margins have declined, revenues were down in both domestic and in export markets. Amit Kalyani, Executive Director of Bharat Forge, joins us now. Good morning, Amit. Mr. Baba Kalyani also detailed some, measures that he wants for the sector, but the government seems to be in listening mode. So what, in the first place, are you expecting from the government that can give a fillip to the auto sector?
So the two-wheeler and passenger car sectors need liquidity boost, and the commercial vehicle sector customers need a demand boost. So demand boost can come through any kind of a norm. If you saw what happened in the past, after 2008, the government came out with this whole JNURM scheme, under which they ordered some 70,000 buses, and that gave a big boost to the entire commercial vehicle sector. I mean, with some of the new measures that the government has undertaken in the last few weeks, there is huge potential for infrastructure development in those areas which have lacked the level of infrastructure development that the rest of India has seen. And if something can be done on a war footing there, orders placed, at least you need to turn the sentiment around, and something on the demand side as well, by kick-starting demand or putting in a scrappage scheme or something that will create more demand for new vehicles.
Oh, absolutely. That is the need of the hour, Amit, and that's what the government has been focusing on. At least some positive statements have come through. But just coming back to your own numbers, margins have been under pressure, and you have indicated a focus on cost cutting. How much as a percentage of revenues are you targeting in FY20 as a reduction in costs?
We are very aggressive when it comes to such measures, and our figures are quite stiff. I don't want to give you a number, but let's just say that if you look at our track record, we have come out of every downturn stronger than before. The 2009, our EBITDA margins were at 21, 2013 they were at 23, 2017 at about 28, 29, and so on and so forth. We've used every downturn, we've mined every downturn, we've used it effectively to both grow our business, offer new products, get into new markets, widen our customer base, penetrate our customers further, and reduce costs. So I think that's what we are going to do.
Okay, got that, Amit. Inventory correction is one of the themes, across the autos, maybe to some extent even oil and gas. How much of the inventory correction is done? How long will it take to complete the remaining?
Unfortunately, in the Indian heavy and medium commercial vehicle sector, I think the inventory correction will get completed this quarter. I mean, they have to, because next quarter will be the final quarter before the switch to BS6 takes over. So from March 31st 2020 they can't sell any more BS4 vehicles, so they have to build a pipeline of BS6 and extinguish their entire stock of BS4 vehicles. So I don't expect this to last more than this current quarter. And the good news on the oil and gas is that the destocking is tapering off, and we are now seeing the demand for this quarter significantly higher than last quarter. I mean, it's not going to be at peak levels for sure, but we are definitely, the trajectory is pointing upwards.
Okay, that's good to hear, at least some green shoots. But margins, once again coming back to that, have contracted about 300 basis points year on year and quarter on quarter. What is causing so much pressure?
There are a few reasons for that. The biggest reason is that our energy cost has gone up substantially because of rates in Maharashtra. So we have seen almost 60 to 70 basis points impact of energy on our margins. Second is that product mix to some extent. And third is that actually the production volume is down by almost 11%. The production value is looking like it's only down by 9% because of the inflationary impact of steel prices. Okay, so these are the 3 or 4 reasons why there is an impact on margins. But again, when you have a downturn like this, the margin impact comes first and then the corrective measures come in place.
Okay. Given the stress globally in autos and, of course, the slowdown in India as well, do you expect pricing pressure? I mean, how did average realizations in Q1, for that matter, compare with earlier? And how are they now in the second quarter?
We are not in a commodity business. That is the first thing. Second is that we have long-term contracts. Third is that we are a technology leader and we are very efficient at what we do. So whatever happens, on the cost side, on the price side, we will, if at all, I'm not saying there is, but, we don't know what the future is. But that is why we are being so aggressive on costs. That is why we are using technology the way we are. And that is why, we are conserving cash. So our whole game in the next 2 to 3 years is going to be maximize free cash flow. We already have a strong balance sheet, strengthen it further so that this last man standing becomes, really an obvious to everyone.
Okay, what is your pipeline of commitment for the Nellore facility and what kind of utilization levels are you anticipating, say, in the first 6 months?
We expect that this business will go from 50-60 crores in the first full year of working to about 300 crores in 18 months.
Okay, and finally, Amit, can you give us some numbers on revenues, total revenues for FY20 and 21?
18 to 24 months. So let's say the first year will be 50-60 crores of business, and the total business in the third year will be in the ballpark of 300 crores. That is the target we have set.
All right.
Okay, all right. Amit, thanks a lot for joining us. That's Bharat Forge at a fresh 52-week low, by the way. This is a stock that has lost 25% of its value this year already and is hitting new lows after weak numbers. Let's take a quick break on that.